When it comes to paying out big dividends consistently, Realty Income Corporation, stock ticker O, talks a very big game. And I mean, if you head over to their website, the very first thing you can see plastered here is that they call themselves the monthly dividend company. It takes a lot of guts to call yourself that, but let me show you why they have backed this up. If we jump over to Seeking Alpha, click on dividends and look at the dividend history for this company, over the past decade, we can see every single month they are not only paying out dividends, they are paying out growing dividends. They don't just increase their dividend payouts every single year, they increase their dividend payouts every single quarter. And in fact, they just recently announced a 2.1% dividend increase. Now, like I said, this isn't their yearly dividend hike, this is a quarterly dividend hike. So for the year, it'll likely be even higher than that. So if we jump over to Seeking Alpha and scroll down, we can see right here, looks like the dividend jumped up from around 25.7 cents per share to 26.25. But if you look just a few months ago, it was even lower at 25.65, and a few months earlier than that, 25.6. So in less than a year, we're already looking at around 3 dividend increases. Again, they're increasing dividend payouts every single quarter. Now, if we look at the share price for Realty Income, it's telling us a story, and it's a story about how investors view risk and how they view interest rates. If we look at the past year, we can see they're down around 11.69%, and if you look at the past 5 years, down around 23.6%. Historically speaking, this company has outperformed the market. So what is going on here? If we look at how Realty Income performed against the market from around 2014 to 2020, we can see, again, way outperforming the market. Realty Income was up around 174%, while the S&P 500 up around 76%, so way outperformance from 2014 to 2020. But then if we look at 2020 to present date, we can see Realty Income down around 23.6%, while the S&P 500 has exploded up around 87.71%. So what's going on with Realty Income? Have the underlying fundamentals of this company radically changed during that time? Well, no, they really haven't, but here's what has changed. The interest rate environment that REITs are operating has drastically changed over the past few years. If we look at the federal funds rate or the interest rate and how it's changed from 2022 to 2023, we can see there were 11 different rate hikes, and we're from around 0.25% to 0.5%, all the way up to 5.25% to 5.5%. And as another example, we have seen drastic changes to high yield savings accounts interest rates as well. Look at this. We're looking at public.com. This is a company I have a link to in the description. They're currently offering a 5.1% annual percentage yield for their high yield savings account. That is a very high risk-free return. Now, historically speaking, when people invest into Realty Income, they expect to get a really nice starting yield on the capital that they invest into this company, but they also expect the adjusted funds from operation to grow, in turn driving up the share price for this company. But here's what's happened. If we jump over to this spreadsheet I just built out, let's go ahead and use the ticker data add-on in Google Sheets to find a starting dividend yield for Realty Income. What we can see is Realty Income currently has a starting dividend yield sitting at about 5.9%. But like we just saw on public.com, high yield savings account are currently yielding around 5.1%. And keep in mind, this is completely risk-free. So what investors are having to ask themselves is, taking on more risk worth receiving a slightly higher starting dividend yield? I mean, there's not a huge difference between the two. It's about 0.8%. And for a lot of risk-averse investors, they're choosing the high-yield savings account. So what's happening is, instead of the money that's typically inflowing into Realty Income stock from investors looking for a nice starting dividend yield and capital appreciation, a lot of them are starting to think they don't want to take on the extra risk and rather get that risk-free 5.1%. Now, the big question is that the right decision? Now, like you should already know, that completely depends on your personal circumstances, but let's look at things from a longer time horizon. If we jump back over to my spreadsheet, we can see I projected out Realty Income's dividend payments over the next 15 years through 2039. Now, if we would have invested in Realty Income at the beginning of this year, let's go ahead and come up here. All we have to do is take the $3.15 that it would be after the dividend hike and divide by the current share price for the company. And you can see the end result of this would be a yield on cost of around 6.04%. So yes, this is higher than the high yield savings account, but is it enough to convince investors to switch over to REITs? Maybe not yet, but we have to keep in mind a REIT like Realty Income has a very strong track record of increasing those dividend payments every single year and paying out dividends every single month. So let's say for the next 15 years, Realty Income has an average dividend growth rate of around 3.25%. We can see by 2039, they'd be paying out around $5.09 in dividend payments. So how would that affect the yield on cost? Well, if we come over here and go ahead and drag this formula all the way over, we can see how the yield on cost would increase every single year. And in fact, at the end of our 15-year period, we're getting close to a yield on cost of around 10%. Now, a yield of around 10% versus a yield of around 5%, that is a pretty massive difference. And we also have to keep in mind, during this entire 15-year time period, Realty Income will be growing their adjusted funds from operation every single year, driving up the share price. So while REITs haven't been a hot investment for the past few years, I do think this creates opportunity. And this is something we're going to see as we keep moving forward in this video. Now, if we jump over to my stock screener spreadsheet, which you can download on tickerdata.com and also get access to the Ticker Data add-on in Google Sheets at tickerdata.com at the link in the description. But there's a concern a lot of people have about Realty Income that we need to address. Let's go ahead and come up here, plug in stock ticker O, and hit enter. Again, thanks to Ticker Data, this data will automatically load in. Now, what I want to talk about here is shares outstanding. Look at this over here. We can see in 2013, total shares outstanding for Realty Income was sitting at about 191 million, but if we look at 2023, it has radically increased all the way up to 692 million. That is some serious share dilution, which is typically pretty bad for investors. This isn't something you want to see. So what's going on here? Well, if we take a closer look, yes, we can see shares outstanding from 2013 to around 2021. They did increase by quite a bit, going all the way up to around 414 million. But if we look at the past couple of years, it's increased at a much higher rate. Now, what is the reason behind this, and should we be really concerned about this? Well, one of the things we have to keep in mind is there's two ways that REITs can grow. And that's because REITs have to pay out 90% of their earnings in the form of dividends, so organic growth becomes pretty hard for them. So the two ways they can grow is they can take on debt or they can issue new shares. So what we can see for the past decade, issuing new shares is something Realty Income has been doing, but they've done it quite a bit more over the past couple of years. Now, what's the reason behind this? Again, a lot of this goes back to interest rates. With interest rates as high as they are, taking on more debt might not be in the best interest of this company. So while that may have been something they did over the past decade, when it made a little more sense when interest rates were lower, over the past couple of years with interest rates higher, I think they've chosen to issue more shares instead of taking on more debt. So is this ideal? No, it's probably not, but it looks like the management team has decided this is the best way for them to grow at the moment. And in fact, if you come over here and look at total debt to total assets ratio, we can see it's actually slightly declined over the past few years. Now, I want to take just a little bit of time to jump into the investor's presentation for Realty Income because you're going to understand why this has been such an attractive REIT for so many people over the past few decades. Let's go ahead and jump over to the fourth slide. And the first thing I want to point out is they have a very strong dividend track record. We can see 30 consecutive years of increasing dividends, 646 monthly dividends declared, 106 consecutive quarterly increases. A lot of people love that, obviously, and we can see a 4.3% compounded annual growth rate for their dividends since 1994. That's pretty high for a REIT for that long of a time period. Now, the next thing I want to point out is one of the most least talked about things that should be talked about quite a bit more when it comes to Realty Income. We can see, yes, they've outperformed the market since they were issued in 1994 with a 13.6% compounded annual return. Obviously, that's really good, but we need to put this into context. What is the risk you're taking on when investing into this company? Well, this company has a very low levels of volatility. We can see the beta is sitting at 0.5, so you're going to see very little volatility. So the risk versus the reward relationship for this company is actually quite good. And if we scroll down, we can actually see this as something charted out. If we look right here, we can see the attractive risk reward versus S&P 500 companies and REIT peers. Realty Income comes in about right here, meaning you're seeing very low levels of volatility with very good returns. So the companies over here, these are pretty risky companies with not quite as good returns as Realty Income. And while there are a few companies obviously with better returns, the risk you had to take on for some of those companies is pretty significant. There was only a few that would be considered less risky that also had better returns. So what exactly does that mean for us as investors? Well, I think if you're someone close to retirement age, you want to make sure you're taking on less and less risk as you get closer to that retirement date. You want to start moving into companies with more predictable, more stable income. And ideally, you probably want to see less volatility. And Realty Income is the exact company that falls into that category. Now, whenever I'm analyzing REITs, I like to see what happened to them during 2020. 2020 was a pretty painful year for a lot of REITs, not just from a share price appreciation standpoint, but from a fundamental standpoint. I want to know what happened to the fundamentals during that time. But we can see Realty Income was still able to grow its dividend payment in 2020. In fact, it grew around 3.1%. Plus, they also saw their earnings per share grow by around 2.1%, which was definitely not the case for most REITs. And then finally, we do need to touch on the portfolio of Realty Income. This is a pretty diversified portfolio, and we can actually see the top 20 clients for them if we look at the percent of annualized contractual rent. We can see some of the key companies renting from Realty Income. We have Dollar General, we have Walgreens, Dollar Green, 7-Eleven, we have FedEx, companies you know like Lifetime Fitness, CVS, Walmart's and Sam Club, Tractor Supply. And if we look at this from an industry perspective, we can see they have a lot of grocery stores in their portfolio, convenience stores, dollar stores, home improvement, drug stores. And something we've also been seeing as of late is they're actually starting to expand a little more in international markets. So places like Texas and Florida, those are pretty big markets for Realty Income, but we can see places like the UK are actually starting to be a pretty large part of their rent base. Now, Realty Income also released their latest quarter's earnings report, which I do want to quickly glance at. If we jump over to this here on Seeking Alpha, we can see Q1 FFO came in at $1.05, which is a beat by around 1 cent, so a very slight beat there. But then they also saw revenue of around $1.26 billion, which was a beat by around $160 million. So that's a pretty nice beat for the company. But something we also have to keep in mind is they were able to reaffirm their 2024 guidance, and they actually even issued a slight increase to net income per share. But overall, with REIT struggling, I think this is pretty bullish news for the company. So finally, the big question we need to answer is Realty Income trading at a good value at $52.18 per share. And to answer that question, we're going to go ahead and jump into my REIT valuation spreadsheet. Again, you can download this on tickerdata.com, but if we come up here, click on O and hit enter, you can see all this data is going to automatically load in. Now, the first valuation I want to look at is going to be our multiples valuation model. Now, how can we perform a multiples valuation on a real estate investment trust? Well, the multiple we want to focus on is going to be our price to AFFO multiple. And you can see the comparable companies we're going to be looking at. There's no perfect comparison for Realty Income, but I think these four are decent. So basically what we do is we take their stock prices and divide by the AFFO to get the price to AFFO multiple. And we can see the average price to AFFO for these comparable companies is sitting at about 15.29. Well, for Realty Income, their current price to AFFO is sitting at about 12.5. That's quite a bit lower than the average P to FFO for these comparable companies. So if we apply the same price to AFFO to Realty Income, we come to an intrinsic value of around $63.85, which is quite a bit higher than that current trading price for this company. Now, the next valuation is actually one I really like for REITs, and it's the historical price to FFO model. Now, the reason I like this one is because it kind of gives us a baseline for how the company has traded historically and how it's been valued historically speaking. Without going into too much detail, basically what we do is we take the historical price per share, divide by historical FFO per share to get the historical price to FFO over the past decade. And if we go ahead and zoom in, here's what I really want to point out. We can see the average price to FFO for this company over the last 10 years has been sitting at 19.69. If we look at it right now for the trailing 12 months, it's actually sitting at 14.39. That's significantly lower than they've traded over the past 10 years. So compared to how they have historically traded, it looks like they're pretty undervalued. And again, I would point back to the interest rate environment that they're currently operating under. That's the most reasonable explanation behind this. Now, the last valuation I want to look at is going to be our dividend discount model. And this is one, again, I really like it for REITs quite a bit. This basically values a company based on how much they pay out in dividends and how much that dividend is increasing over time. And keep in mind that they did just have that recent dividend increase to around $3.15 per share. So ticker data is able to automatically pull in the historical data, but I still need to apply my growth rate projection. And historically speaking, it has been around 3.25% as of late for this company. So if I go with a dividend growth rate of 3.25%, discount rate of 8%, we actually come to a dividend discount model price per share of $68.47 for Realty Income, quite a bit higher than that current trading price. So if we jump over to our output tab, we can see the two different valuations we use with the AFFO and dividend discount model. Now, historical price to FFO is not included here because it doesn't give us an exact price per share, but again, we did come to the conclusion that it did look like they were undervalued compared to how they had historically been trading. But if we average these two valuations, we come to an intrinsic value of around $66.16 per share. If we look at the current trading price, it's about $52.18. So with a 10% margin of safety, you could see our acceptable buy price sitting at about $59.54, and with a 20% margin of safety, acceptable buy price of $52.93, meaning Realty Income is within our buy range. Now again, we have to keep in mind, just because the company is within our buy range doesn't necessarily mean it's going to have market-beating returns over the next 20 years. Obviously, this isn't a high-growth company, but they have a very nice starting dividend yield, very predictable dividend growth, and I expect the adjusted funds from operation from this company to continue to grow over time, which will drive share price appreciation as well. So go ahead and let me know what you think of Realty Income in the comments down below. Like always, if you'd like to be able to download this spreadsheet and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.